Welcome to our presentation, a continuation of our discussion on the simulated CD covered call approach, where we were asked by a YouTube commenter to compare the simulated CD covered call versus doing the simulated CD approach with a cash secured or naked put position. Let's take a look at the historical comparison. Now, why are we doing this comparison? A few weeks ago, Mike E. had asked a question: how would we use the default simulated CD search on power options or other long-term approaches for income? Well, we recorded the webinar as always, posted it on YouTube, and we got a comment from Andrea. Couldn't this be done with naked puts? Continuation: if the stock falls, take assignment, then sell covered calls, or buy the put back cheaply. Well, there's a lot to unpack there in a historical search of putting in the defaults of do we take assignment, do we buy the put back and roll it down, and so forth. Let's start off with just a straight comparison. We're going to take the simulated CD covered call default search and power options and run the results, see how they performed. Then we're going to create a search for the parity trade out of the money cash secured put options and see how they performed over the same time period. What was the simulated CD screen? It's a default covered call search and power options that's looking for far out in time, in the money covered calls to give a high downside protection. In other words, how far the stock can fall before you're technically losing money on the position, while still offering the potential for double-digit returns. The appeal of this approach is it's less activity than rolling and reopening covered call positions month by month or week by week. Although, as we know, we always get a higher annualized return selling shorter term than selling farther out in time. Another allure of this approach is it's almost a fire and forget position. Set the deep in the money covered call far out in time, leave it alone for 10 months, 11 months, have a high downside protection, still the potential to make double-digit returns. However, we know that nothing is fire and forget. The default criteria that we're typically looking at are covered call positions that are greater than 180 days out in time, looking for a max return if assigned, annualized of at least 7% or more. We're looking for a range in the money of 15% or more to give us that high downside protection. Some basic requirements for minimum option bid price and bid-ask spread, while looking for a broker recommendation of less than 2, which means a strong buy or buy recommendation, looking for stocks trading above their 50-day moving average, stock prices between $9 and $100, PE ratio between 10 and 80, and looking for mid-cap stocks or higher. Now let's set a standard. The initial filters is greater than 180 days out in time for the call that we'd be selling in the simulated CD covered call approach. This gives a mix of expiration dates, but let's keep the comparison simple. Let's just go 1 year out in time. We're going to search using our historical backtesting tools on the first day after standard Friday expiration, the third Friday of the month, looking 1 year out in time for our covered calls. We're going to assume no rollout plan or no adjustments for either strategy. So our first run for the simulated CD covered calls, we run in January of 2016. The standard Friday expiration was January 16th, but no covered calls matched the default criteria from January 19th through the 21st. So our selected date was January 22nd, 2016. We have 2 covered call results that match the criteria: Electronic Arts, EA, and Foot Locker. As you can see, both offer a 23 and 21% downside protection, but not as high as a percent return if assigned as we were hoping. We see an 8.8% and 7.2% assigned, not quite into double digits. But the fact that there's only 2 results tells us that this is after a previously bad market condition leading up to January 2016, so there were only a couple of stocks that matched that basic criteria. Anytime we run any Smart History Excel backtest screen on any power option strategy, we simply click Calculate Group Results to see how these performed to expiration. And our first batch of results is pretty successful. We see that we have a 100% success rate. Both EA and Foot Locker reached the max return of 8.8% and 7.2%, as both positions at the end of January expiration on January 19th, 2017 were above the call strike prices. We see an average return on the two trades of 8%, but meanwhile, QQQ was up 15.6% during that same time period, and SPX was up 15.8%. Well, this makes sense. We wouldn't see as much return as the broad market because we capped the gain to the upside with the covered call approach. And again, we're assuming no management, and we wanted the higher downside protection of 23%, give and take with the covered call position. But we'd call this successful perhaps for this portion of our portfolio for 1 year of trading. Let's move on. We freed up our money on January 19th. We move forward to the next cycle. Following Monday, January 23rd, 2017, we run our next search for the simulated CD covered calls for the next year. Market conditions are better. We get more results as we expected. We see examples such as AU, CRUS, Kate, Lulu, Yandex, and more. We see some double-digit returns, 11.4%, 11.3%. We see the downside protections that we wanted, 22%, 26%, 30% even, and more. Well, we calculate the group results going forward, and here we see a 100% success rate of the top trades that match the criteria. The average return is 9.7% on those positions. At the same time, Qs are up 25.8%, and SPX was up 19.4%. There is an outlier here, and that's the Kate Spade Company. This trade ended on July 11th, 2017. And the reason why is that Kate was bought by the parent company that owns Coach and another type of high-end company there. It's now called Tapestry. That happened sometime around July 11th. But we're going to count it as the full return here in this position. So we have a 100% success rate for our second year. Didn't quite get the double-digit returns we wanted, but we're still doing okay. Next cycle, we run the search. We have our results. This was from the January 22nd, 2018 to 2019. We have our top 15 trades, and we only have a 27% success rate. There's a lot of red, a lot of losses, even with the high downside protections of 30%, 33.8% or more. We're seeing losses of 47%, 35.2%, and others. 4 out of 15 trades were only successful. Average loss on the 15 trades was 13.6% down. Same time, the Qs were down only 1.7%, and SPX was down 6.1%. Why is this so disastrous? Well, it was the year that was one we would like to forget. We started off 2018, that February 5th to February 9th crash of the China trade tariffs and the China trade war. Saw some volatility and recovery. Then about March 20th to April 5th, we see another downturn. Ups and downs, a little bit more of a downturn. We start to come back up, then another downturn in June, and then about 4.5 months from July to September of good upward trend. Then that disastrous October, that volatile November, and that would love to just forget December of 2018 leading into January of 2019. And then we started to see a strong recovery, but it wasn't enough in that scenario. So it's disastrous, and it's going to bring that portfolio down. We go to the next year. Try to forget 2018 and 19, but we're not going to forget it for our analysis. January 22nd, 2019, going to the leaps of 2020. We see some common names. MOMO, Etsy is in there. Navistar, of course, Foot Locker, later on Kirkland Lake Gold, and more. We have a 73% success rate. 11 out of 15 positions met our criteria and were assigned for the full profit. However, we do have one big loss here on St. Maryland of down 15.1%. Not as bad as the numerous ones we saw in 2018 without any management. This brought the portfolio down. Even though we have a 73% success rate, we're only at an average return of 8.2%. The Qs up 27.5%, SPX up 21% roughly during that same time period. Now, as we're analyzing any historical trades from our search, we can also look at each individual position. Let's take a look at St. Maryland. We had entered the position potentially, and we were hoping to see a double-digit return. But we saw that loss of around 13%. Did it ever hit a profit? And here in the individual analysis, we can see that we hit the max profit of 3.7% about 3 months into the trade on 4/22. Would this have been enough to close it? Meaning, normally when you look at a position, you're expecting a 12 or 15% turn. You may consider closing it early if you've reached 50% of your maximum profit. This was maybe only 1/4 or 1/5 of the expected max return, maybe even only 1/3, not half. So it's unlikely we would have closed this for the gain early to not have taken that 15% loss. However, you can see shortly after that, it dips down below. You've got the SPX and QQQ returns in there as well. It hits the bottom near that October range of the year, in this case, before it starts to move back up towards a potential profit, but it never quite reaches there and still hits the 12% loss at expiration, almost 13% loss at expiration. So again, management is important, but it's unlikely we would have been able to close this one for a profit to increase the return for that year to double digits. Let's go to our last cycle. We would have run the simulated CD covered call screen again on January 21st, the Monday following the standard Friday expiration. Looking for leaps in 2021. Again, we see Etsy in there, EXEL, Yeti's up there as well. And here we've got a 93% success rate. 13 out of 14 trades were successful. The big loss, of course, occurred on Diamondback Energy as a 13.2% loss. But we do end up with an average 10.5% return over that 12-month period with no management on these covered call trades. And we likely would have not managed them anyway to hold them closer to full profit at expiration. SPX is up 12%, almost the same amount, a little bit more over that same 12-month period. And the Qs were up 28.4% as well. So the total tallies in summary, year by year, 2016 to 2017 for the simulated CD covered calls saw an average of 8% return and 100% success rate, while the average between SPX, QQQ was about 15.7%. The next year, a little bit better, but not quite at our double-digit returns. We're at a 9.7% average return on the top 10 positions. 100% were successful, while the market as a whole averaged about 22.6% return. The year we wish we could forget. 13.6% loss average on the top 15 trades. Only 4 out of those 15 trades were successful for only a 27% success rate. Market average down about 4% in that same time frame. Going into the next year again, didn't quite hit that double-digit return, only had a 73% success rate, which isn't bad, but again, it's only a 73% success rate, 8.2% average return, while the markets were up on average about 24.2%. The following year, do a little bit better, 10.5% average return on the top 14 trades. 13 of the 14 trades were successful for a 93% success rate, and the markets as a whole had an average of a 20%. We take the totals, not compounding, just adding up all the numbers. We had taken $50,000 and put it into even distribution to all of the trades, closed it out, started with a new $50,000. Total return would be 22.8%, which over 5 years comes out to be a 4.6% return. We had a total of 40 wins out of 56 total trades for the simulated CD covered call approach, with an average of 8 successful trades per year on an average of 11.2 trades entered per year. Now, if we just take the straight numbers, 40 wins, 56 total trades, we get a 71.4% success rate. But if we add up this actual success rates and divide by 5, 100, 100, 73, 93, and 27, we see an average of 78.6%. I think the 71.4% is a little bit more fair because it's skewed in the case of that first year with only 2 trades and both were successful. And of course, the total returns, just adding them up over those 5 years, was about 78%, SPX and QQQ, SPY and QQQ, with an average yearly return of about 14.8%. So we're under where we expected, and we're not seeing the full amount we'd expect to see, and most of that was pulled down, obviously, by 2018 to 2019. So what can we conclude from this before we get into the comparison? Naturally, this is not as fire and forget as some of us assumed when we saw the initial simulated CD covered call approach. 2018, 2019 would have taken care of that. Obviously, management is needed at times. It's not just as fire and forget as we expected. Now, we saw a couple years there where we saw an 8% return, but the average markets were up 15%. I think one year is at about 9%, and the markets were up 22%. As it is a covered call trade with a capped upside, seeing half to 1/3 the return in the market is generally expected. That's not shocking. The average success rate that we saw is what I'd expect for an in-the-money covered call. And we saw a true 40 out of 56 trades, or 71.4% success rate. That's about what we'd expect within the money covered call approach. I will be fair, and what we are missing from this comparison is the dividend payments that we did not factor in to the total return if we had held those covered calls for the entire year. 14 out of the 56 trades were dividend-paying stocks, and that's missing in that overall return that we saw. So we probably would have done better with the simulated CD covered call approach than this quick example. But I do want to include a quick comparison there. We saw our returns for this quick simulation, not including dividends, but I wanted to point out that the monthly picks of the day covered call returns that Ernie had tested and posted over a 3-year period from 2015 to 2018 had an 85% success rate with a return of 3.9% on average for each individual position. But starting with $100,000 over that 3-year period, the ending cash amount was $159,000 for a 59% total return, or averaging 19% per year. It is a little bit different time frame than we just showed, but I wanted to mention that as something that's also available on Power Options. In addition to that, the weekly picks of the day that Ernie tested as well to try to maximize return, he tested over a 1-year period, 2015 to 2016. And he saw about a 77% win rate, close to what we're seeing here, with the average return on the winning trade at 2.3%. But of course, little unfair compounding, starting with $100,000, the ending balance of that test was $124,000, or 24% over the year, with 104 trades total for the weekly covered call approach. But I just wanted to point that out. Let's get to our actual comparison here. Now that we have a base, let's talk about the naked puts, cash secured puts. We're going to take that same stock criteria. Average broker recommendation less than 2. Stocks above their 50-day moving average. Price only between $9 and $100. PE of 10 to 80. And a market cap, mid to large cap stocks only. We're going to look 1 year out in time, same expiration time frame. We're going to look for a percent to break even of greater than 20. As we saw, most of the downside protections were in the 20, 22, 23, 30% range. For a naked put, we call it the percent to break even. We're selling an out-of-the-money put so the stock can fall to the put strike price and lower based on the premium before we start losing money on the trade at expiration. That's the percent to break even. And we're going to look for a similar comparison of the percent naked yield of at least 7% or higher. And just to satisfy everyone, here's the side-by-side comparison, looking for the, again, I mentioned 1 year out in time, the returns on the covered call on the left, the same stock criteria, and what we created for the simulated CD parity screen on the right for the naked put, cash secured put search as well. First cycle for the simulated CD naked put screen, January 22nd, 2016. Only 2 trades are met, First Solar and Lulu. Different stocks that came up. But once again, we hit calculate group results, and here we're not as successful as we'd hoped. FSLR drops down to 34.42, and we actually see a 24.7% loss. Only a 50% success rate with an average return of negative 5.9% for the first cycle. Yeah, that's going to put a damper on things, isn't it? Did FSLR ever hit a profit? Once again, we use that same feature to analyze the individual position. And in this case, you can say on March 22nd, the liquidation value was 6.2%. That was probably about half the naked yield that we were expecting for this position, maybe a little bit less, but it's possible with management we might have closed this 2 months in to get a 6% profit as a success rate, and then looked into another position or maybe rolled the First Solar position as well, depending on our goals. So close to half, we might have closed it, but again, we're assuming no management, so we're going to take the 50% success rate and a loss of 5.9% for round number 1 with our simulated CD cash secured put parity. Next cycle, January 23rd, 2017. As we saw with the covered calls, we get more results now. AU is in there, CRUS, MOMO. GEO is in there too, and that takes us to a loss of 29.4%. However, 14 out of 15 trades were successful for a 93% success rate, but we didn't hit a double-digit yield. We're only at 6.8%. And why is that? Well, some of these didn't hit the max return as we expected, although we did have a return. And GEO down 29% probably took out 2 or 3 previous wins. What do I mean by not the maximum return? CXW, the second trade, when it was at 28.34, sold the 25 strike put for 310, a 12.4% yield. But at January expiration, the stock was trading at 22.34. It's about 270 in the money, 266 in the money. So we had to pay that back to close the put as a loss. So we only saw a 1.4% return, but it was still a return. So 14 out of 15 or 93% were still successful. But we didn't hit the max return on that one position and took a fair loss on the GEO position. January 22nd, 2018, to our leaps out to 2019. Oh yeah, that year. We know what's going to happen here potentially, don't we? 27% success rate, 4 out of 15 trades. Same success rate we saw with the simulated CD covered call approach. MOMO did good for us. PAGP and XST and 5 Below did okay for us. Everything else in the middle was rough, with almost a 45.5% loss on US Silica Holdings, 33% loss on VIPS. Kind of hard to overturn. Loss of 15.8% on average, compared to the loss of 13.6% we saw with the simulated CD covered call approach. QQQ, SPX down the same ranges that we saw as well. Let's move on to the next year. Get out of that 2018 to 2019 cycle. See the trades here. Here are our results of the top 15. We knew that St. Mary Land and Exploration would be a loss, because it was for the simulated CD covered call as well. In addition to that, this might have had a return as we saw with our previous analysis, but I don't think it was half of the 17.1% yield we expect. It's probably around that same range of 3.7% at one point before it started to lose. We see 12 out of 15 were successful for an 80% success rate, but again, an average return, average yield of only 7.6%, not hitting double digits. Meanwhile, the Qs and SPX up 27.5% or almost 21%, respectively. January 21st, 2020, looking at 2021 leaps, our last cycle. Not too bad. 14 out of 15 are successful for a 93% win ratio. We finally get to that double-digit naked yield we wanted of 11.3%. QQQ again up 28.4, SPX up about 12%. We're about even with the return on SPX with the simulated CD naked put parity cycle that we saw. The only loss wasn't even that bad. 58.com WUBA, a little bit below the short put strike price, but we took in 630 a premium, maybe have to buy back at around 660, so we're only down 0.5%. Not too bad of a loss in this case, but it still counts as a loss, but we're still looking pretty good for our last cycle. Total tallies and summary for the Parity simulated CD naked cash secured put. First year is going to skew the results. We see a loss of 5.9%. Only 2 trades were entered. 1 was a loss, 50% success rate. Second year, 6.8% average yield, 93% success rate, 14 out of 15 trades. Remember, for the simulated CD covered calls, we saw a 100% success rate in this case. Meanwhile, the markets were up an average of 22.6%. The year we don't want to recall, 2018 to 2019. Average return of minus 15.8%, only a 27% success rate, with markets down about an average of 4%. 2019, 2020, getting back into positive, 7.6% average return, 80% success rate, and then the final year, an 11.3% yield, 14 out of 15 trades successful for a 93% success rate. The only loss we saw was a small loss of 0.5%. Meanwhile, the markets were up an average of 20.2% or so. Assuming that we just took $50,000, added it to all the trades evenly if we could, depending on how much money was required, took the return, and then started with a new $50,000, just adding up the returns, loss of 5.9, gain of 6.8, loss of 15.8, gain of 7.6, gain of 11.3, just a 4% return, or an average of 0.8% per year. We had a total of 45 winning trades over 62 total trades for a success rate of 72.5%, which averaged about 9 winning trades per year out of a total of 12.4 trades. If we just add up the success rate, divide by 5, we only see a success rate of 68.6%. That also is skewed because the first cycle only had 2 trades and one of them was a loss. And of course, we saw the devastating 2018 to 2019 27% success rate. Again, we see the average of return for SPY and QQQ combined, their average return, 78% total over the 5 years, or an average of 14.8% per year. Now again, as a comparison, we also have the monthly picks of the day, naked put screen on power options, and the weekly picks of the day as well. The monthly picks of the day naked put screen essentially showed a 33% gain over the testing cycle of that 1 year, 2015 to 2016, which of course wasn't included in our screens in that case. And it was average success rate, I believe, of there were only 4 losses there and 20 wins. It was an 83% success rate. The weekly naked puts over that same year again showed a 47% return, 76% winning trades. There were 25 losses over those trades, which averaged 3.5% per loss, and the average winner was a 2.1% yield. All right, so that's just that comparison. And our direct comparison The overall return was about 22.8% for the 5-year period for the simulated CD covered calls, not including the dividend, which averaged about 4.6% per year. With the simulated CD cash secured puts, we only saw a total of a 4% total return, or 0.8% per year. Hurt by that first year that only had 2 trades and one of them was a loss, so it is kind of skewed to that. But of course, the devastating 2018 to 2019, which is an actual incorporation as well. A total of 45 wins over the 5 years in 62 trades for about a 72.5% success rate for our cash secured puts simulated CD parity, compared to 40 wins out of 56 trades for the simulated CD covered calls, which came out to be about 71.4%. So they're both pretty close in that case. It's just the yields didn't favor the naked puts, and that first year did kind of skew the results because it was only a 50% success rate and a loss of 5.9%, which was only about 1/5 or so, or maybe even 1/7 of the total trades that were found in the remaining 4 years, where we saw 10 results, 15 results, and so forth. But again, comparison to comparison, both only had 2 trades in that first year. And we do have to remember that the covered calls did not include the dividend payment, so it actually would have been higher. I do have to add that historical records and backtest results are not a promise for future returns or success rate for either the simulated CD covered call search shown on power options or the simulation of the simulated CD cash secured put that we used. This was simply an exercise to see how the two would have performed against one another. We do see a stark difference in performances of trades that match the criteria for the two strategies. Many similar stocks did appear. And once again, this was done without any management rules or rollouts applied to either approach, which would be necessary, I feel, to hit the targets you desired, with either the simulated CD covered call screen shown on power options, or if you decided to create a similar search using the out-of-the-money cash-secured puts for 1 year out in time for higher protection while still hoping for a good 7, 8, maybe 10% yield over a 12-month period.